Welcome to Yahoo Finance Uncut. I am your host, Jared Blikre, and we have a very special guest here today, Alfonso Peccatiello, founder and CEO of the Macro Compass. And let's just dive right into this. Alf, I've been following you at the behest of somebody I work with in S4A for about a month or two. And congratulations, because you are opening, is it a can of worms? No, you're taking the lid off of the financial markets right here and revealing what a macro investor who makes a lot more money than I do is looking at every day. And some of it might be a little bit in the weeds. I'm going to give everybody out there some cautionary words here. But the hope is that everybody's going to come away with a slightly better understanding of exactly what macro is, what the environment is, and what the pros are looking at here. And even if some of it goes over your head or goes over my head, we're going to stand by here to hopefully explain as much as we can. So Alf, let me just get your take. I like to ask all the guests as a first question, how did we get to here? And here is a very difficult place. Worst year for 60-40, maybe ever. You take a look at just about anything that had worked in the prior years, not working this year. And it's been, I used the phrase can of worms before. That's, I think, what a lot of investors feel like we're in right now.
First of all, thank you for inviting me here. It's a pleasure to be interviewed by you and to be on the show. When it comes to how we got here, it's actually relatively straightforward with hindsight, I would say. It's that things have materially changed from a decade where investors could buy NASDAQ and long-end bonds and go to sleep and generate 15% returns and Sharpe ratios, so returns adjusted for volatilities, which were basically the same of a hedge fund, by simply owning 2 or 3 assets in their portfolio. These times are over because inflation is back. And so one of the luxuries of having run a large investment portfolio like I did is to be able to talk to policymakers, to be able to discuss with them what's the view of the world they have. And I vividly remember in 2019 in a London conference talking to a vice president of a large central bank. And I was asking him, what's your framework for making decisions when it comes to monetary policy? And remember, in 2019, there was no inflation basically all over the world. And he said, Alf, well, it's relatively simple. We as policymakers have a mandate for price stability, but most importantly, we have a mandate to keep our credibility very high. We have a mandate to make sure that investors believe that we will meet our targets. And by doing so, we want to have a controllable scenario, controllable environment ahead of us, where if things accelerate, we hike a bit. If things decelerate, we actually cut and loosen policy a bit. Well, in 2020, in the end of 2021, the a bit part of this became too much, which means inflation and inflation expectations rose way above any comfortable set of status quo or controllable environment for any policymaker, Jared, which means, as he was trying to explain, that once you get into a deflationary or a too strong inflationary environment, central bankers won't react linearly anymore. They will react more than linearly. They will do everything they can to try and regain credibility, because credibility is the strongest asset of a central bank.
All right, we're talking about credibility here within the construct of central bankers. And of course, they pull the monetary strings in the global economy. We also have the fiscal side. I want to just take a step back here. A lot of our viewers here, as experienced as they might be in trading or investing, they might be only familiar with the stock side, with the fundamentals. We talk a lot about the Federal Reserve because it has huge implications for the market here, but there are other factors and economic data as well that the average investor just doesn't necessarily know how everything puts together or fits together the way some of the professionals do. So I'm wondering if you could just step back a little bit and tell me about your macro background and how that informs the way you're looking at things just now, the way you were just describing.
Yeah. So Jared, I run institutional money for almost 10 years for a global bank headquartered in Europe. It's ING Group, headquartered, but actually it's a global bank. It's in Australia, New York, everywhere in the world. And what I was doing is running a $20 billion portfolio, mostly focused on fixed income instruments. rates, credits, products, including derivatives, and the weeds of the repo market and all the monetary mechanics were close to my heart because of that role. And at the end of the mandate, the role expanded all the way to equities, foreign exchange, and basically a multi-asset mandate that encompassed the $20 billion portfolio I was discussing. Now, because of that mandate, effectively, I had to become very familiar with both the bond market and central banks and monetary mechanics. And from that angle, you start to understand that really our monetary system is strongly misunderstood, I would say, by most people out there. So there is a lot of chatters about the Fed prints money, or who prints money, and how does it get to the real economy, and what's the impact on inflation. So actually what I would like people to understand here is that our system works as two tiers of money. There is money that the real economy uses, that we use, citizens and corporates actually use in the real world. And there is money that banks and financial institutions use, and that's a different form of money. And so these two actually are interconnected to a certain extent. But for the last 2 decades, if you think about it, starting all the way from Japan in the 90s to basically the QE experiments of Europe and the US in the 2010s, actually, what happened is that real economy money and financial money were hardly printed at the same time. What was printed in very large amounts very rapidly were financial forms of money, due to quantitative easing mostly. So Japan started all of this in the 1990s, where the Bank of Japan created reserves on the liability side of the balance sheet to buy assets on the asset side, which were government bonds. So this was bank reserves thrown at the banking sector in Japan. But if you look at how much banks were lending to the real economy, bank loans were actually shrinking at the same time, Jared. So already there, it was visible that this influx of financial form of money, bank reserves, was not directly reflected into real economy money, because real economy money gets printed when the government is making deficits. So it's reducing our tax base, it's making sure that our bank deposits grow, that we have less taxes to pay, or even like in 2021, is sending checks at home for people, or when banks are lending, which means they're creating credit, they're increasing our purchasing power. Those two phenomena, the creation of financial money and real economy money, are interconnected, but not exactly the same thing. Now, in 2021, things materially changed because we did both at the same time in gargantuan amounts, especially in the US. And that's what really changed the picture.
So we have these gargantuan amounts, both on the monetary side and the fiscal side. I'm going to ask one of my producers to throw the dashboard that you have created for the Macro Compass, which is your website. And it's hard to see there, but it contains all kinds of items that I just drool over. A lot of these are based in derivatives. And this is kind of what the pros are this is what the pros are looking at here. And I was wondering if you could break down some of the information, because it's going to be a lot different than what the typical retail investor is looking at.
Absolutely, Jared. So at the end of 2021, I was still running money, but it actually bugged me that the access to this kind of institutional information, data set, knowledge that I just discussed briefly here in only a small portion was only closed in an ivory tower, effectively, only reserved to people which were in the business. So I decided to start publishing, actually quit the business, so quit banking and running money, take the leap of faith and share my knowledge with people, which I did on Twitter and on the Macro Compass, which used to be a newsletter, very popular one, but I'm now graduating that newsletter into a macro platform. And the snapshot that you gave there is part of what I will deliver for people. So in order to make sure that we fill the gap between the institutional knowledge at the pro level, including the data you were talking about, which are basically non-accessible for retail investors, and retail investors themselves, we need to step up the game. And the macro platform I created at the Macro Compass allows people to use and look at the same interactive tools. There you go.
I just want to interrupt you for 2 seconds here. This is something you're offering as of November 11th, and this is a brand new product. This is an exclusive here that we're showing everybody today. So, and yes, it is paid. We're going to get to those slides in a second, but just want to get everybody's head around the fact that finally there's something out there that explains a lot of what's going on. Please continue, Alf.
Thanks, Jared. I really appreciate this endorsement. Nice intermezzo. But the idea, guys, is that you should get the same access to the same level of macro data, market data, formatted in a way that you can understand and follow that exactly like the pros do. So you can make decisions informed like a pro investor does. And that's the mission behind the Macro Compass. So those interactive tools, for instance, Jared, would allow you to follow the bond market exactly like I do, exactly like a fixed income investor does. All this data that you were looking for regarding the repo market, the pricing of central banks ahead, anything you can imagine that gets you access to that kind of information that you need to experiment yourself, to get your hands dirty, and to get to the same level of a pro investor. You will actually have that on the Macro Compass, together with, of course, my explanation, my deep dives, my macro reports that people are already used to on the Macro Compass, and model ETF portfolios and tactical trade ideas. We basically try to offer everything, a complete package that will send people through a macro learning journey to step up their game from being a retail investor with limited access to data and knowledge, as you correctly depict, to somebody who has the same access, the same information, the same data of a pro investor.
And I want to highlight for our viewers here, it might not be for you. This is admittedly in the weeds, and it's a very much a pro tool, but it's a tool that the pros would use geared towards everyday average investors. And I just want to highlight, even if somebody doesn't subscribe to the full premium version, they can get access to your commentary on a free basis, And I just think it's really interesting to see some of the things that we're looking at here. These are based, maybe like you can explain five-year swaps and why the Fed is looking at some of these things, what the credibility indicators are. And let's just dial it back a little bit and talk about Jay Powell, because this is a tape program, but we're all coming off. This is going to be released within a few days, and we're going to run it a couple of weeks. We have the last Fed meeting very clearly in memory here. And so we've hiked 4 times, 75 basis points, but it's all been about the nuance. Every time there's a Fed meeting, I read your wrap-up post and I get more insights as to what is exactly going on. And I'm going to ask my producer in your response if we can roll your latest missive here. There we go. Pivot from hawkish to, guess what, more hawkish. And that's what it seemed like was happening when Jay Powell was taking the lectern and talking about the latest monetary decisions. So can you talk about how some of the esoteric things that you look at in terms of your dashboard, how they fit into what's happening in a real world basis right now?
Yeah, that's a great question, Jared. So one of the indicators that I built is something called the Powell Credibility Indicator, which is something that professionals in fixed income world would look at today. And you can actually replicate that yourself, including an historical chart on the Macro Compass. So what that is, Jared, is the following. If Powell is deemed to be credible by fixed income investors, what will happen is that nominal Fed funds rate in a year from now will be priced to be well above predicted levels of inflation a year from now. In other words, the real Fed funds rate will be priced to be positive, well positive, a year ahead from now. And why is that the case? Is because investors look at the past. And every time the Federal Reserve was serious about fighting inflation, was credible, that's why the name of Powell Credibility Indicator, every time the Fed was deemed to be credible about inflation, they raised nominal Fed funds well above the level of inflation at that point in time. So today inflation is, in core terms in the US, above 6%. Right? So that metric, if Powell wanted to be deemed credible today by market, it means he should have nominal Fed funds over 6%. We are not there yet, but everybody and their mothers out there expect inflation to slow down. We all hope that at least at some point that inflation will come down from today's levels to somewhere still very high, but say in the 4 or 5% area. Now, if Powell wants to be deemed credible, Jared, he will have to project a path for Fed funds that is still above those levels of inflation. Now, you can see that he tried to do that in March, April. If you look at that series on the chart, you can see that, the Powell Credibility Indicator was actually going up. The market was starting to believe Powell, but it was really the Jackson Hole speech in August and the latest press conference that sent this Powell Credibility Indicator all the way above 1.5%. 2%, which indicates the market really now strongly believes that Powell is going to keep nominal Fed funds rate not only above the level of inflation, but 2 percentage points above the level of inflation in a year from now. In other words, Powell is coming across now as very convincing, but what you guys should care the most about is Powell cannot afford losing this credibility, which means if he dials back his stance, the market will immediately challenge his credibility through this indicator that you can follow live on the Macro Compass to understand how the bond market is guessing Powell, is getting credibility into Powell. How does this translate into the dollar, into equities, into credit spreads? And that's important, Jared, because if the Federal Reserve would actually be deemed credible by the bond market, would keep policy very tight and nominal Fed funds way above the level of inflation, it also means conditions are tight. It means earnings will go down. It means unemployment will go up. It means things will go down, and it gets reflected in other markets too, like we have seen this year with equities tanking 20% plus across the board.
So Alf, as you're watching one of these pressers unfold, you're watching your dashboard update in real time. Just for the benefit of our audience here, what do you think most people have gotten so tragically wrong this year? And I got a few things I could throw out as well, but if you could just put a name on it, what are people really principally getting wrong?
They thought that the Fed had their back, and in reality, the Fed was stabbing them in the back. Ooh. Now, this sounds a bit strong, but it is exactly what is happening here. People are using, and still also professional investors I consult with, hedge funds, family offices, in the first half of the year, Jared, they were using the same framework that they were accustomed to over the last 10 years. And that framework is that every time markets went down, the Federal Reserve came in and actually stepped in to rescue the market. Do you remember 2019, for example, with the equity markets dropping 20% in Q4 2018 and Powell pivoting very aggressively in January 2019? Investors were using that framework. Investors thought there was a Fed put. This time is materially different because the Federal Reserve wants demand to slow down. And one of the ways to do that is to make sure that the wealth effect, which has been created through higher house prices, higher equity prices, higher bond prices, higher 401ks across the board, that wealth effect diminishes so that people have less propensity to consume and to spend, and therefore less propensity to fuel inflationary dynamics. It's an opposite environment, Jared. It's not the Fed supporting the market anymore. It's the Fed actually cheering to a certain extent about market repricing back to a reality that is more consistent with 2% inflation. This year alone, we wiped out, I think, $35 trillion of market capitalization. It's massive across the world. And the housing market is just starting to roll over. But if you look at absolute levels, we just went back at levels of market capitalizations that were in early 2021. So we basically just retraced the excess animal spirits that characterized 2021, with this excess risk-taking in stocks being valued 20 times sales, 50 times sales, 100 times earnings. We literally just repriced down those excess risk-taking, but we haven't done yet enough damage, if you ask me.
Well, that's what I was going to say. It sounds like there's more bad news to come here, because if we've only gone back to 2021 levels, and yet we're dealing with at least a decade of history here of people's mentality getting used to the ZIRP, I'm thinking there has to be more unwinding. And where do you see that happening?
So the unwinding in this case will now move, I think, to the second leg of the bear market. So bear markets historically have two legs. The first is a leg where the excesses are taken off. So multiples that are extremely high tend to contract back to some level of normalcy, which is more or less what we have seen in the first 10 months of 2022. The second leg of the bear market is characterized by the negative impact that tightening financial conditions have on earnings, the labor market, with a lag. So when you tighten monetary policy, what you do is you reprice the cost of capital for a company. You make borrowing more expensive, you make the cost of equity more expensive, you make basically levering up your balance sheet more expensive. You put zombie companies in trouble. Every business model that worked with interest rates at 0%, Jared, doesn't work anymore with interest rates at 5%, right? That's what happens. So that's the first leg. The second leg is even the strongest companies actually get hit a little bit when it comes to this protracted over time. So while at the beginning they will cut discretionary spending, they will cut marketing maybe, right? But they won't cut the labor force. Later on, when the economy slows, they will be forced to cut a little bit on investments, on hiring, and that's what we're seeing today. How many hiring freezes have we heard going on in tech? Yes. How many layoffs are we hearing about going on in tech? And so if you give it enough lag, the damage that the Fed has done to financial markets will also translate inevitably to some damage to earnings and to employment. And that's the second leg of the bear market. It's a slow grind down that is not driven by valuation only, but also by earnings coming down and people repricing down the trajectory for earnings going forward. It's a bit like 2001. In 2000, the dot-com bubble deflated. We repriced away most of the excesses that we had in 1999 and early 2000. In 2001, earnings dropped, unemployment rate went up. That's the playbook that we are playing right here, right now.
I'm almost afraid to ask, is there a third leg of the bear, or is there just two that we're talking about here?
I would say that the second is the one we need to focus the most on here. So if you are an investor, this idea that you can chase a Fed pivot when core inflation is at 6% is ludicrous. It's completely ludicrous. Powell is trying to make that clear at every press conference where he goes on stage and clearly kills any hope of a Fed pivot. Yet people are conditioned to think about that, Jared. And I think people should be open instead, take a step back and think of what is the Fed trying to engineer here? They're trying to engineer a weaker economy. They even told us, Powell told us that households will need to go to some unfortunate pain, and those are the unfortunate consequences of having to bring down inflation. This is what we're talking about. This is the environment of 2023, where people need still to be very conservative in their asset allocation and be very selective about when they take risks, where they take risks. This is not the moment to be aggressive. The third leg of a bear market is what I call the desperation leg. The desperation leg, the potential desperation leg, is actually a very good investment opportunity for people, because in that environment, Jared, the risk premia widen. People don't want to touch anything with a 10-foot pole, but that's generally an environment where opportunities arise. So right now, I think the second leg is the one to pay attention to and not get carried away with these Fed pivot stories, with this. Do you remember in July where the new bull market in tech, it was declared because the Nasdaq rallied 20% from the lows. We will have these bear market rallies. We will, also in 2023. But please do not miss the forest for the trees. We are still looking at a weakening growth environment in 2023, and therefore the asset allocation needs to be defensive.
Well, I think a lot of people their only reference for a bear market might be in the very recent past. We're talking about an analog with 2000, 2001. By the way, I'd point out that the low wasn't until about March of 2002. So these things can really drag out here. And along the lines with what you're describing in terms of the first phase of the bear market versus the second, an old adage pops into my head. If they don't scare you out, they wear you out. And I think we're entering the they wear you out phase right here, where people, you can also, kind of amusing, people have likened this to the 5 stages of grief, which I don't have memorized, but a lot of people are in that bargaining phase right now. Like, if we do this, well, I could still be okay over here. And meanwhile, it's really a series of, I should have done something different several months ago. What do you say to people that have been suckered so far, and a lot of people here buy the dips, and maybe they bought too many, don't really have enough cash on the sideline? What do you say to people who are just kind of mired and stuck where they are in this bear market and looking to somehow claw their way out when hope is not a strategy?
Yeah, hope is not a strategy. That's correct, Jared. So what I would say is that a lot of investors, also at the pro level, tend to actually confuse cycles with trends, Jared. So what I hear a lot is that inflation will become sticky and it will, basically stay around 4 to 5% for the next decade. Okay. And while that might be true, there are macro cycles that happen in the meantime that are much faster than these trends. So what investors are looking at right now is a cycle, is a macro cycle, which requires risk management and portfolio management. That is an active one to protect your wealth in the meantime while the long-term trends play out. So investors should be always able to think about the risk management process. And right now, a prudent approach to risk management and asset allocation is what is required to survive the volatility and the excess volatility we will see in 2023. Think about this, Jared. If I look at retail investors' flows in ETFs, this year, actually, there have been massive net inflows in equities. Massive net inflows.
Yeah, even into ARK. I don't know about recently, but it was kind of famous for at least the first 6-7 months of the year. They were going gangbusters in terms of ETF flows, ARK Innovation Fund.
And again, this dollar cost averaging is a strategy that worked fantastically between 2010 and 2020. Why? Because central banks had their back. Central banks had a put, basically, where effectively they would step in and make sure financial conditions didn't tighten enough, so that people could actually come back and spend and try to boost inflation and boost economic activity. Right now, central bankers are trying to do the exact opposite, Jared. They're trying to make sure that excess spirits, animal spirits, are not back into the game again. So that's, if so far you have been hurt by the bear market, that's fine. it happens. The definition of a bear market is that it hurts and wipes out wealth. Now, risk management can help you, especially if you follow a data-driven macro approach, can help you manage around these risks a bit more. What I want to come across with is that the past is irrelevant because it has already happened to our portfolios. It's what will happen in 2023 and going forward. And again, I feel that there is way too much optimism about a Fed pivot, about inflation dropping like a stone. And also, let's talk about the Fed pivot for a second, Jared, yes. Because the Fed will pivot. By definition, things don't last to eternity. So at some point, the Fed will stop raising rates. At some point, the Fed will even cut rates. That's undeniable. It will happen. Now, why will that happen? That's the question that I don't hear many people answering. And in 2001, the Federal Reserve cut interest rates in 3 months by 150 basis points. So yes, the Fed pivoted. They cut rates by 150 basis points in 3 months. If I ask you, what was the equity performance and the dollar performance in those 3 months when the Fed literally pivoted by cutting rates? Most people would say equities rallied, the dollar weakened. No, sir. The dollar rallied another 6% and equities dropped another 12% in those 3 months. And why? Because the Fed pivoted, because the economy was coming down very hard, because the labor market was weakening aggressively, because earnings were revised down. A Fed pivot is not necessarily bullish if it comes when the economy is already rolling down very hard. A Fed pivot might be good for bonds at that point. It might be good for defensive equity sectors. But it doesn't mean you can go back to the 2021 playbook and lift all unprofitable companies out there because the Fed is cutting rates. It's not that simple.
I want to get to something you pointed out, and I think is extremely relevant, which is Paul Volcker was the last Fed chair to preside over an era of high inflation, roughly 72 to the low 80s. So this was a long time ago. This was over 40 years. And he wrote a book about it, calling Keeping at It. Jay Powell is a big fan of Paul Volcker. We know this because he talks about him quite a bit. And there are articles where he's quoting it. If you listen to the FOMC pressers, as we do religiously around here, he uses a phrase, keeping at it, or something very similar. And I think that's key because one of the things that Powell has said is that history has judged Volcker to be successful because he took the pain. He did what was politically not very popular at the time. It wasn't popular by almost anybody. A lot of people went out of businesses. Tons of small businesses reviled Volcker back in the day, but history bore out his legacy. And I think that's where Powell sees himself. And therefore, if Powell's willing to take all the pain of reputation damage by things that have not occurred yet, the pain that may occur in 2023, 2024, to anybody, I think, who doubts his resolve, just look at that and maybe give a fresh window there into some of the psychological underpinnings of this.
100%. Volcker's book is actually named Keeping at It. And tell me how many times you have heard Powell say, the Fed will stay the course, the Fed will keep at it until we win the battle against inflation, until inflation slows down. We will keep at it. He has repeated that a lot of times, and that is not a coincidence because Volcker is his hero. Powell wants to leave a legacy, Jared, which is a legacy of somebody who's laid the inflation dragon. He doesn't want to go as somebody who lost the inflation battle. He doesn't want to be Burns. He wants to be Volcker. And so you need to understand that and his incentive scheme, because he wants to leave a legacy of somebody who actually slayed the inflation dragon. And to do that, there was only one small mistake Volcker did in the 80s. He gave up his inflation fight the first time a bit early, just a tiny bit early. When he saw core inflation coming down on a trending basis, he decided to stop raising interest rate, Jared, for a while. We're talking about 3 to 6 months. That was it. And he was punished bad by inflationary dynamics. There was a second wave of inflation, which was faster than the first one, and forced Volcker to hike and tighten even more aggressively and raising rates all the way to 15% in the US at some point. That's where treasury rates were, 15% in the US, to make sure that he finally definitely won his inflation battle. And that was the point, that second leg of ultra tightening that killed many businesses, that did a lot of long-lasting damage. It was necessary pain at the end of the day. But Powell admires Volcker as his hero, and he wants to learn from history. And there is one mistake he doesn't want to do. After being so wrong for so long about inflation, after over-easing for so long in 2021, he now feels guilty about it. You can see it in his voice. You can see it in his expression. And if there is one mistake he doesn't want to do, is to basically allow loosening of financial conditions too early, stop the fight too early, declare victory too early. He will not do that. He was very clear about that. He will keep at it. And so people should actually listen to Jerome Powell and understand where he comes from, and also understand that the Fed pivot is a pipeline dream in this environment. It will happen, but it will take a lot of time. And when it happens, it's because Powell is completely sure that he has won his inflation fight, which also means that the economy has slowed down so hard that people are getting unemployed, that wages are not rising anymore, that a lot of damage has been done to the real economy. And tell me, do you want to buy stocks when earnings are dropping and people are getting unemployed because the Fed has pivoted? You want to buy stocks when the Fed has pivoted and earnings are still growing, which was what happened in 2018, in 2019, and in any episode when there was a drawdown in the last decade. But this time there will be a lot of damage before the Fed pivots. That's a different a different background.
Alf, I'm really glad you're here to explain this to everybody, and I think people should just really let that sink in. While I have you here, I want to ask you about the Bank of Japan and the head of Bank of Japan, the head of Bank of Japan, Haruhiko Kuroda, whose term is up in April. Now, this isn't as relevant to U.S. investors perhaps immediately, but Japan is a really interesting circumstance here with the amount of QE that they've been able to get away with as a percentage of GDP. It's just off the charts, but it looks like their yield curve control strategy, which is underpinning their monetary policy right here, and they're maintaining a negative interest rate on the very short end of the curve that everybody else in the world has disengaged from, anybody who had it. How sustainable do you think the Bank of Japan's actions are, and what are the potential headwinds that we could see? Any kind of black swans emerging from this? I know black swans inherently not able to predict, but it looks like there's some potential storm clouds on the horizon with respect to Japan that we could be facing.
Yes, that's a very good question, Jared, because many global macro commentators solely focus on the US. And while our system is US-centric and US-based, there are still so many things happening now on the fringes. And so I think Europe or Japan or the UK are very interesting cases. And Japan is a place where, again, you need to put everything into perspective and incentive schemes of Kuroda, the head of the Bank of Japan. So over the last 20 years, Japanese core inflation has averaged minus 0.2%. I want to repeat it, minus 0.2%. So prices have not increased, they've gone down on average against 20 years ago. Can you imagine that? Now, in that deflationary environment, Japan has tried almost everything they can to revive their economy, both through the intervention of the government. Japan has delivered fiscal deficits of 5% of GDP on average over the last 8 years. Every single year, 5% deficit. The Bank of Japan has done quantitative easing in large scales to the point where buying government bonds was basically unfeasible because they owned 60% of the market, and they moved from quantitative easing to yield curve control. So they basically pinned the level of rates. They're trying everything, Jared, to revive inflation, and yet they haven't succeeded. Kuroda's term lasts 8 years and it ends in April next year. And right now, at the very end of his term, Jared is getting a chance to get inflation back to 2% in Japan as well. It has nothing to do with QE. It has very little to do with Japanese dynamics. It has to do with global dynamics and supply bottlenecks and energy prices, but it's getting there finally. Now, people that think that this person would erase all the policies that he has implemented over the last 8 years that have in his narrative gotten him there at the end of his mandate are just very misguided. Now, he will keep yield curve control until March. The market understands that now. He didn't understand it in June, where there was this frenzy about yield curve control being revised up, and that would have an impact on the yen. Again, it's about incentive schemes. Kuroda will keep everything as it is until March and try to declare victory by saying that his policies finally brought inflation back to Japan. Now, interestingly, for global markets, it's what happens next that matters. Because between now and April, what Japan will do is the following. They will use their gigantic amount of foreign exchange reserves to try and defend the yen from falling too rapidly. We have seen the yen falling against the dollar at a very rapid pace. And again, coming back to what we explained before, policymakers like controllable situations. They like status quo. And having your domestic currency falling very hard against the dollar is not a controllable environment. It's something that is outside your control and outside the predictability pattern. So what they did is they're trying to stop it. Now, the only way to really stop it is to raise local interest rates so that people actually get money back into Japan and they can buy and invest in government bonds yielding 1 or 2%. Right? Now, they won't do that until March. So the way to stop the bleeding is to use the large amount of foreign exchange reserves that Japan has accumulated over the last 20 years. Japan is one of the largest capital exporters in the world. Japan has accumulated trillions of dollars, euros, and other large foreign exchange reserves over the last 20 years. And now they're going to use it in reverse, which means they're going to sell down dollars to try and stop the bleeding and to try and keep the yen stable until Kuroda is gone, and the next person at the Bank of Japan might direct a new monetary policy setup. The problem with this strategy is twofold. The first is the amount of foreign exchange reserves in Japan is very large. It's $1 trillion, which is quite a large amount. But the amount needed to stop the bleeding on the yen against the dollar is also very large, which means Japan can go on like this for a few months, but at some point investors will be challenging the long-term viability.
Correct me if I'm wrong, but a lot of those dollars those US dollars are tied up in bonds, so they actually have to sell the bonds first, and that creates its own feedback loop.
That is a great point as well. So for the first, I actually wrote the piece on the Macro Compass about this FX reserves situation. Japan, of the $1 trillion in reserves, they have roughly 130 billion in deposits at foreign central banks in dollars or at the BIS, which means those are just cash dollars. Imagine like that, Jared. And they can be easily sold away in the market. But those have been depleted. By any calculations I've made, basically, Japan has depleted their cash dollars. The remaining $850 billion are tied up in bonds, as you said, which means that anytime Japan wants to stop the bleeding in the dollar yen, they need to sell US bonds. By selling US bonds, they raise interest rate differentials between Japanese bonds and US bonds, which is a vicious circle, widens even more the attractiveness of the dollar against the yen. It's a very tricky situation to manage, but still, I think, because of the incentive schemes of Kuroda, Japan will not let yield curve control go until his terms expire. And understanding these things really is all about understanding the incentive schemes of these policymakers. And all this knowledge was tied up in this ivory tower. And I want to make sure I can, share it with people a little bit more.
All right. Well, this is a great time for a segue. I want us to roll your rollout of the Macro Compass and what you're offering to what I would say democratized macro finance here. If we can roll those 4 full screens here about what you're offering and also show the dashboard as well. And while we're talking, Alf, and we're going to continue to show this, could you bring it back home here? What should U.S. investors be paying attention to? And given the expected pain that you expect the markets and investors to go through next year as well, does your macro framework tell you where to invest within? Does it give you specificity within, for instance, U.S. stock? We like retail here. We like consumer discretionary versus staples. We like growth stocks with strong balance sheets as a caveat. How detailed does this get with respect to what a lot of our investors would be wanting, which is really just a focus on stocks here?
Yeah. So the Macro Compass basically has a top-down approach to macro, which starts from understanding where we are in the cycle. Are we printing? Are we accelerating economic growth? Are we tightening policy? Are we loosening policy? Starting from this big picture, data-driven view, Jared, it then zooms into an asset allocation, which includes stock sectors to be preferred in a certain cycle. Now, in the cycle that I see ahead, looking at my models for the next 6 to 12 months, at some point, you actually might want to start dabbing into stocks, but into certain sectors of the stock market. So right now, the sectors a person would want to start looking at are the sectors that are not dependent on cyclical economic growth, are the sectors that are the most stable, defensive, strong balance sheet sectors out there. Now, what these sectors broadly are pharma, utilities to a certain extent, although utilities might have some idiosyncratic issues in this part of the cycles. Those are the most defensive sectors that people can look at. Now, there are sectors instead that are very strongly driven by cyclical economic growth. Those are sectors that need strong earnings to perform well, right? So those sectors are instead, I think, not to be preferred because earnings will disappoint pretty aggressively next year. There are then sectors that are very dependent on animal spirits, on valuations expansion. This is, for example, high beta tech stocks, the ARKs of this world. Those also are not likely to do very well because, as we discussed, Powell will keep at it until inflation actually slows down very hard. So in early 2001, which is a period relatively similar to what I expect in 2023 ahead, there were sectors in the stock market that delivered a decent performance, utilities being one of those. And why? Because utilities are often considered to be pretty acyclical sectors that are considered to be a proxy of the bond market. So if the Fed starts cutting rates, then bond yields stop going up very aggressively, which is also reflected in the attractiveness of these high dividend paying stocks, generally speaking, which are not very well driven by earnings. That makes these kind of sectors relatively attractive. The same one can say for pharma, especially some pharma stocks are looking pretty decent. They have a very decent free cash flow yield and dividend yield over the long term. They are not uberly dependent on strong earnings growth, et cetera, et cetera. So I would start looking at the defensive sectors rather than the most aggressive sectors of the stock market.
And Alf, we got a few minutes more. To anybody who just wants to ask the question, all right, so things are not good right now. When are we going to get back to the market where you could just buy call options every week on meme stocks and print money to the moon? We just want to get back there. When is that coming again? I got my own answer, but I'll wait for yours here.
Guys, that's a very tough question. I'm going to say not anywhere earlier than late 2024. For that timing, you need first the pain to go through the real economy. Then ultimately inflation will slow down. Then we have done enough damage as well to financial markets and earnings and employment that makes the Fed relatively at ease with easing. That will be easing not to fuel animal spirits, but to repair the damage. And after the damage is partially repaired, then you can get back to taking risks in a pretty aggressive way. That timeline is not anywhere earlier than 12 to 18 months at least.
Sounds like a very long slog. I know you're going to be on top of it. Really encourage anybody to at least sign up for the free trial. We've put that on your screen here. You can go to the macrocompass.substack.com website, and there you go. There are the price points. Really enjoyed hearing everything you had to say. I could probably do this for another 5 hours, Alf, but thank you for bringing your wisdom that you've learned over the years and just being able to offer it and your opinions to the retail investors, because there's a ton that we don't see and there's a ton we don't know about it, but at least we can get a glimpse of it. And that really helps, I think, with investor psychology here. It's not like the game is just rigged against everybody. There's a lot going on that we're not necessarily seeing, and you're helping to shed some light on that. So thank you again, Alfonso Peccatiello. Hope I got that right. Founder of the Macro Compass and CEO. We're going to talk with you soon. I know it here. And thank you, everybody, for watching.